If you want to know where asset prices are going, if you want to know where Bitcoin and crypto goes, gold, real estate, and any other stocks or commodities, then you have to understand one single thing, and this is global liquidity. And so I am having the master of global liquidity on. I'm talking about Dr. Michael J. Howell. He's worked in finance for over 30 years. He was the former research director at Salomon Brothers, and during that time, he developed the concept of global liquidity. This is a lot more than just M2. He's focused on analyzing liquidity trends and capital flow data, which I believe is the most important thing to watch in financial markets. He's also the author of multiple books about this, including Investing in Emerging Markets and more recently, Capital Wars. Again, like I said, if you want to know where asset prices are going, Bitcoin, crypto, real estate, it doesn't matter. You have to understand this one thing, global liquidity. So let's go ahead and jump right in. All right, Michael Howell, the author of the book, The Capital Wars, and someone who has been studying liquidity, global liquidity for a long time, something that I've been talking about for the last year. I'm super excited to have you join me today, so thank you for taking the time. I've been subscribed to your Substack, been reading your articles, obviously your book as well. But just for the audience, just go ahead and give us a little bit of a background, and why have you been studying liquidity cycles for so long, and how long has that been?
Well, hi, Mark. Yeah, it's a great privilege to be here. Thank you for the invitation. It kind of goes back. I mean, my studies of liquidity and why it's an interesting subject go back to probably, at least 25 years, probably a tad more actually, when I worked for the US investment bank Salomon Brothers. Salomon Brothers was the world's biggest trader in terms of world fixed income markets, forex markets, etc. And to understand trading, you had to understand where the money was flowing. And that was really the critical thing. If you could understand these capital flows and where they were shifting, you had a pretty good insight. It was actually insider information in many ways. You had great insight into understanding the direction of macro markets. And so what I did was, when I was there, to basically put in a framework that allowed us to monitor flows of money around the world, understand what central banks were doing, etc. And the whole concept of global liquidity really grew out of that. And global liquidity is very simply flows of money through international financial markets. It's as straightforward as that. That's what moves the world.
Yeah, I read about Stanley Druckenmiller and how when he first started his career, the person that he was working under said, or he brought all his research to him, and here's what's going on in the economy, and here's what's going on with the company, and here's their price to earnings, and all these different things, and they said, no. Take all that and come back when you know what moves markets. And he said, or moves asset prices. And he says, what do you mean? This is what I learned. And he said, no, that's it. And so Stanley Druckenmiller came back and said, no, what moves markets is liquidity, which is exactly what you're saying. So you said simply, it's the flows of money through the financial system, but it's a little bit more complex than that. I think most people, at least in my sort of sphere, are very U.S. centric, and so they think of just like U.S. M2. And I think that's a little bit oversimplified for liquidity. So is it just like excess bank reserves? Is it money on the sideline that's ready to trade these assets? Or how would you define global liquidity?
Well, I think you, as you rightly say, one has to be more granular and look at some of the components. And some of the things you cite are important, some are less so. You talk about M2, which is sort of a traditional measure of the supply of money. Now, we're looking at money in a general sense, a generic sense, obviously, but we're not looking at an M2 aggregate. And the reason being is that M2 measures effectively retail deposits in high street banks. Now, if you believe that that's the only important thing in the world, then I'll come quietly and drop the global liquidity idea. But actually, high street banks have been eclipsed a long time ago. What you've got now, you've got international markets, you've got wholesale markets, you've got repo markets, you've got what the Federal Reserve is doing through QE, you've got extraneous things like, just think the Swiss National Bank is a major investor directly in the US equity market. It's a big holder of tech stocks. All these things are sort of unusual factors, but they're liquidity-driven factors that come in and move asset prices. So one's got to have a pretty broad or eclectic view of what matters. And what we're looking at is, to give you a sort of stricter definition, we look at the interventions of central banks around the world. I would say as a caveat, this is not just about looking at the size of balance sheets. You've got to look at the active components within the balance sheet. Not all the elements on the balance sheet create liquidity in markets, for example, and the Federal Reserve is a great example of that. We also look at what the banks are doing in terms of bank credit. We look at shadow bank credit. Shadow banks have been an important element in the whole equation about global liquidity, particularly in the last 20 years. That's a key factor. And then we look at repo markets, wholesale market activity. We also look at cross-border flows. They're also a critical element. I mentioned the Swiss National Bank in the US, but look at it the other side. Look at US investors in emerging markets. They often control the pace of many of these markets with their capital outflows.
Yeah, so it's pretty complex. There's a lot of things that go on. And being in a debt-based monetary system and money is created through debt issuance, then a lot of what you have to look at, I would imagine, is sort of the bank's willingness to lend. Like how tight are their lending markets, maybe the SLOOS reports, things like that?
Yeah, exactly. I mean, I think the thing is that the SLOOS report, as you mentioned, is a pretty good heads up. I mean, unfortunately, it tends to be a bit of a lagging indicator. So we're looking earlier in the pipeline as to what is actually going on to actually see the sources of that liquidity coming into the banks. So the banks are operating. The banks will sort of change their view when they've got more opportunity to actually raise capital in markets themselves. So it may be that very short-term money markets become liquid, and the banks will respond to that through the SLOOS or the Senior Loan Officers Survey, for example. In terms of what is sort of critical to understand, in terms of what the main things that we look at what the Federal Reserve is doing. I mean, that clearly goes without saying. It's the most important central bank worldwide. We've got to understand the Federal Reserve. We also look at the People's Bank of China. The People's Bank of China is bigger in some ways than the Fed. It has more reach, if you like, through the Chinese financial system. It tries to keep the Chinese financial system on a relatively tight rein, for example. It's very important for understanding the tempo of the world economy because China has such a big economic footprint, particularly in the Asian region. And then we also look at the pool of collateral. And the reason for emphasizing collateral is that ever since the global financial crisis in 2008, most lending in the world, particularly wholesale lending, is backed by collateral. It's like, taking the analogy of a home mortgage and saying, well, okay, let's just extend that idea. Everyone who borrows now has some collateral, not necessarily residential real estate, but it could be a Treasury bond or it could be an equity, something which is actually put up against the loan for security. And the collateral base of the system is increasingly important. So these are the factors that we mainly watch. Federal Reserve, People's Bank of China, and the pool of collateral. Those are key things. But I would go on to say is that one of the things that we've got to recognize now is the whole nature of the financial system has changed. And we characterize it really by saying that, if you go back and pick up an economics or a finance textbook, it will tell you that interest rates are all important. I mean, of course, almost every day in the Journal or in the Financial Times, you find people dancing on the head of a pin about what the Fed is going to do in terms of setting Fed funds next month or next FOMC meeting. Generally, in our view, that doesn't really matter very much. We're not in a world now where interest rates are really ruling the tempo of the business cycle. We're much more rather than being in a new financing world, we're in a refinancing world. And your point about debt is extremely important because in a world of debt, you've got to refinance that debt. With something like $350 trillion of debt worldwide, with an average maturity of that debt of about 5 years, the system is basically refinancing or needs to refinance about $70 trillion every year. That's an eye-watering amount and actually quite demanding on the financial system. It's not interest rates that matter in that case, it's actually the capacity of the financial system to roll the debt. And that really is a liquidity feature. So that's why global liquidity is so important. And I go on to say, as an end note on this, is that if you look back, every financial crisis that I can think of in the last 20 or 30 years has fundamentally been a refinancing crisis. It's been a time when debt gets out of step with liquidity.
Now, you talked about the interventions of the central banks around the world have changed. And it looks like it really changed around 2008 with the introduction of QE, at least in the United States. And then the sort of ever-increasing willingness to intervene in markets, as we saw, obviously, through 2019, 2020, and so forth. Even, the bank collapse, Bear Stearns went bankrupt in 2007. It took 7 months to get a Fed bailout. In 2023, when the banks collapsed, we got one in 6 days. So we see like the willingness to intervene has changed. But if we go back to these refinancing cycles that you talk about, it's almost like I've seen like a YouTube video where you put all these metronomes for keeping time, and they're all on different beats. But after a period of time, they all get on the same beat. I don't know if you've ever seen that before. And it's almost like this refinancing cycle has been synced up, maybe since 2008 when the whole world went to zero interest rates, got refinanced, and now we're sort of in this like 4-year refinancing cycle, which also seems to align with the presidential cycle. And also you talk about Bitcoin as well, and it also coincides with the Bitcoin halving cycle. And so I guess my question to you is, does it seem like we're now in this rhythm of refinancing that seems to be about every 4 years first? And then do you think it's because of those interventions that happened in 2008?
Yeah, I think you've absolutely nailed it. I mean, I think the key point here is that if you go back historically, the business cycle was typically 8 to 9 years in length. And that was really driven by the capex cycle. In other words, how businesses would actually invest in new capital, plant and equipment, etc. And that tended to be an 8 to 9 year cycle. What's happened in the intervening years, in maybe the last 20 years, is that that business cycle length has sort of concertina smaller. So it's sort of shrunk into a period of nearer sort of 4 to 5 years. And that basically reflects this debt refinancing cycle. And as you correctly spot, what you're getting is everything is moving in that harmony now. You've got Bitcoin, you've got central bank interventions, you've got the presidential cycle. All these things seem to be in a sort of 4-year window, interestingly enough. Now, it's kind of difficult to form cause and effect out of that, but I think debt is a critical factor. And I think that if you look at the interventions of the central banks, they're increasingly coming in with alacrity, of course, to try and smooth the system if there are any hiccups in debt refinancing. And they move much faster, as we've identified. So in 2007, it took a long time before the Fed really showed its hand. But if you look at what happened in the COVID crisis, or look at what happened in the repo crisis in 2019, the Fed was moving very quickly. And I think that you can even see in the shorter term instances where you get wobbles in markets, such as SVB, that crisis. The Fed is there almost immediately. And I think what this is really telling us is that the primary goal of the monetary authority in the US, and maybe in every country now, is to preserve the integrity of the sovereign debt markets. This is absolutely critical. With so much debt and so much public debt around, they need functioning markets. And a very good heads up to that, if people can remember the instance, is to go back to Britain and the so-called Liz Truss moment, when an incoming British Prime Minister sort of, screwed the markets badly by outrageous statements. It ruffled the market's feathers significantly. And what you got was a huge sell-off in the British sovereign debt market. And that was a wake-up call to central banks and finance ministers everywhere to say, look, we simply cannot allow this to happen. Had this happened in the US Treasury market, the core of the system, we'd all be in penury now. The system would have collapsed or threatened to collapse.
So I want to talk about their capacity to intervene, but just sticking with this 4-year cycle. So you do see it sort of on this 4-year cycle. As you said, the business cycle has sort of gone from about an 8-year cycle down to about a 4-year cycle. And it seems like the metronome's on time, and it does seem to coincide with these things. And so then if we're in, as you said, we're sort of in this basically, a refinancing cycle. So now all this debt gets kicked down the road, and in order to refinance the debt, we need more debt to refinance it. And it's almost like every 4 years we sort of see maybe this, I think maybe you framed it up as liquidity air pocket, where maybe there's not quite enough debt to like roll it over until then the central banks sort of intervene and inject this new liquidity to kick that can back over, which sort of resets it like another 4 years.
I think that's absolutely right. I mean, what you're getting is exactly that kicking the can down the road. I mean, it's almost impossible for any administration, whatever the stripe, to actually change the outlays that the Treasury is undertaking, because most of those outlays are sort of they're non-discretionary spending. They're things which are mandatory, like Social Security, Medicare, ultimately defence. These bills have to be paid, come whatever. And it's very difficult to actually offer any cutbacks in spending. I mean, they can tweak around with discretionary spending, but it's such a small item of the budget now, it's pretty much irrelevant. And then you've got on the other side taxes. Taxes are clearly an unpopular area, but will any administration, particularly a marginal administration, where you've got, you're scrambling for votes, put their hand up and say, look, we're going to raise taxes? I mean, nobody's going to do that. So what you've got is this funding dilemma, which really comes back to the fact that the real strength of economies comes back to whether they've got a reserve asset. So the US dollar is in a prime situation because the US is a pristine borrower internationally, at least until it's not. And that makes funding the US deficit a lot easier than if you had to fund maybe the British deficit or a deficit in an African country or a smaller Asian country. These are a lot more problematic. And so what you need is that integrity of the markets. And that's why the Treasury and the Federal Reserve, in my view, are putting such a high priority in maintaining the stability of US debt markets.
Yeah, and then you mentioned like the PBOC. So you watch other central banks like the PBOC, but if sort of in 2008 all these interest rates got reset down, then even though we have different countries, different central banks with different priorities, they all sort of got synced onto that cycle. And then furthermore, with PBOC, for example, they're currently printing or injecting hundreds of billions of dollars into the real estate markets to prop that up currently right now. And so that's just global liquidity. And then a lot of that global liquidity can go into global assets like commodities or Bitcoin, or even potentially back into the United States. Is that sort of the way that you look at this global liquidity?
Exactly. I mean, a lot of this is fungible. I mean, it would really depend. I mean, in China, they've made announcements that they're going to basically issue debt for real estate. I mean, or real estate support. I mean, the question is who buys the debt. That's really the critical thing. And with every financial system, whatever the nationality, what really matters is whether the debt is bought by a credit provider or whether it's bought by a private saver. If it is bought by a private saver, it's just basically switching money from one pot to another, so there's no net effect. If you're giving, or if it's the credit provider like a bank who is buying the debt, then what you're doing is monetizing the debt. In other words, that's what textbooks would tell you is a bad thing because you're creating a lot of excess liquidity. And my view is that that's what the gold market and that's what Bitcoin are currently telling us right now, is there is concern about monetization. Now, if you look at what Janet's been doing Treasury Secretary Janet Yellen's been doing, basically I think she's been very astute in managing the supply of coupon debt in the US. And what she's done is created, given the fact that we know that there's got to be a lot of demands on the coupon market, given the fact the deficit is $2 trillion a year or running at that sort of clip, there's got to be a lot of coupon issuance. In other words, anything which is of a maturity of more than about a year. So any Treasury security that pays a coupon is deemed to be coupon debt. And the Treasury normally has a preference for sort of issuing debt around about 7 years or thereabouts. But what she's done is very carefully avoided the longer end of the market for issuance, focused on the shorter end, and in particular used bill finance as a plug for any swings in the deficit. Now that's actually pretty astute management, at least in the short term. I mean, she'll be caught out in the long term, almost unquestionably. But in the short term, it's helped the Treasury market, and it's probably meant that yields are actually lower at the longer end now than they should really be by rights. So the yield curve is flatter than it would be. It should be steeper right now. But generally speaking, there's been quite a clever move by the Treasury in actually how they've run things in the US. But the problem sorry.
Go ahead. Tell me what the problem.
No, I was going to say the problem is quite simply is that what's happening is that if you're issuing so much short-dated coupon debt, in other words, at the front end of the market, 1-2 year debt, and you're issuing a lot of bills, it's the banks who tend to like that area of the market. They buy those Treasury securities, and that is pure monetization. So you're actually feeding, the wolf who is creating the monetization, or if that analogy works. But effectively, that's what's going on. So America now is doing what Milton Friedman has been counseling against for decades and decades and decades. It's effectively printing money.
Right. By issuing the short-term bills, I mean, it's basically injecting money directly into the economy. I mean, we consider in the U.S., if I had $100 note, it's a $100 bill. I mean, she's basically issuing. So that's a bill. That's a note with a 0-day, coupon, if you will, right? And she's basically issuing the same thing into the market, which is just short-term cash. Now, you said that it's brilliant for her to do that now, I guess, in MMT lens, maybe not from an Austrian lens, but it's keeping the system alive, if you will. But you said that she'll probably be called out in the long term. So what does that mean?
Well, I think there's a rule of thumb. There's no hard and fast rule here that the Treasury tends to fund the deficit about 80% with coupon and about 20% with bills. Now, that's, as I say, not set in stone, but that's really been the benchmark many people have looked at. And what Janet did about where we now 12 months ago is actually flip that round. So it was almost 80% bills and 20% coupon. So there was a very significant shift. There was a huge amount of bill finance going through the system. Now that's actually ebbed down a bit, but generally speaking, it looks as if the trend in bills is going to be higher than we saw before, and that may be a concern. But there's a lot of opportunistic moves going on. But the fact that she starved the market temporarily of coupon supply was something that I think, in my view, has actually kept yields lower than they would otherwise be. I mean, I think the US 10-year should be over 5% now, given everything else that's going on, the inflation backdrop, the economy, etc., etc. But they're moving in that direction, but they're not there yet. They're being held back.
Now, you had talked about earlier about basically we have this pool of collateral, which is the base of the system, and how important that is. And so in this debt-based monetary system, it seems like because money is created through debt issuance, if I go get credit, then the dollars are created into existence, which means the dollars are the liability against the debt, which then the debt becomes the asset itself. And then that debt is the asset or the collateral, the base of the system, which then collateralizes other debt. So that's sort of this Ponzi scheme, if you will, right? So then debt is collateralizing more debt, which is part of the reason why they can't allow any of this collateral to sort of lose value, because then it will unwind the entire base of the system. Is that a good way to say that?
Correct, yeah. And I think it was actually, if my history is correct, it was Alexander Hamilton who first made that observation, that the stability of the US financial system depended on a solid government bond market. And that's what has transpired pretty much ever since. So if you get that system being challenged, then there is an issue. Now, I think the challenge that, we all face, not just America, because the dollar is the global financial asset, but what we all face is the fact that at the moment, something like 80% of the world's savings, surplus savings, go into US financial assets. I mean, an eye-wateringly large amount. But if you look to counter that, US government outlays are up 40% since the COVID crisis. Now, the second number, the 40%, is telling us that the fiscal situation, the budget, is running out of control. And that is likely to undermine the integrity of the Treasury market in the longer term. That's the concern. Now, that, in my mind, is why you've got these jumps going on in the gold price and in Bitcoin. And I just think of Bitcoin because it acts very much like this. It's moving rather like exponential gold. It's moving at a much faster pace than gold, but it's moving in the same direction.
Now, Bitcoin is one of my main topics. I'll be speaking at the Bitcoin conference here in Nashville coming up in 2 months. So if anybody in the audience is listening and wants to come see me in Nashville, use code MarkMoss to save 10% on your tickets and come join me there. So I want to definitely talk about Bitcoin with you, Michael. But kind of going back to this sort of cycle that we're in. So we're printing money to continue to kick the can down the road. We have to continue to issue more debt to refinance the existing debt. And basically this is debasement. Right, so they're debasing the currency. So asset prices are going up because the value, the purchasing power of those dollars are going down. So if you think about it in those lens, then trying to understand the financial market. So if you think about the financial market, looking at the stock index, S&P 500, or let's use the NASDAQ, then it almost seems like the price of those assets is moving up, not because, as I started out talking about Stanley Druckenmiller, not because of what's happening in the economy, not because of their earnings or their profitability or any of those things, but really it's moving up as a function or an inversion of the debasement. That's the way that it looks like to me. So fundamentals are out, and we just look at the debasement or the liquidity moving these asset prices up. And so, one, tell me if that's correct, and then observation number two, which I want to get into, when it looks like different assets move at different rates. So in your research, on your Substack, which we'll link in the notes down below for everybody, they should definitely check it out. You can show that gold moves on liquidity, but Bitcoin moves many times more on liquidity. So I guess question number one, do we look at fundamentals out and now looking at debasement or liquidity moving asset prices up like that? And then two, why are different assets moving at different prices like that?
Well, I think that your observation is correct. Basically, there is an underlying force, and that underlying force is the flow of liquidity in markets. My view is that it's global. It's a global liquidity dimension. It's not just a US centric one. You've got to look into it. You've got to take into account what everything is, everything that's going on globally. We're an
Yeah, and
international.
just to interject, I mean, you already said like the Swiss bank is already interjecting money into the U.S. markets, and so is the
Correct.
PBOC, and so is every other market in the world. It's like George Soros'
Yeah.
imperial circle. So like all that money just sort of comes into these global assets, right?
Exactly, yeah. I mean, you can actually go back. I mean, George Soros's Imperial Circle is a very interesting thesis. It's almost exactly the same as maybe the more popular and probably maybe more transparent milkshake theory that Brett has articulated many times, which I think is a very neat way of looking at it. And basically, that we're in that frame. So you've got to look at global money, and you've got to accept the fact that liquidity is fungible worldwide. But there are these dominant trends, and it's very clear that you've got certain trends which are stronger than others. You've got a gold and a Bitcoin trend; those look pretty well established. You've also got a US tech trend; that's another one that looks pretty well established. But what's going on behind that is that liquidity is a major feature driving them. Now, it so happens that these fall into the category, without being too wonkish, of being long duration assets. And basically, if you've got a long duration asset, it tends to be very sensitive to liquidity. And a long duration asset is something that has a long term payback, if you think about it. Now, you've got other assets which fall somewhat beneath that. You've got things which are more cyclical, maybe things that are more connected with the business cycle. I would maybe counter what I've just said by saying that liquidity is not the only factor. You've got to also take into account the business cycle itself, because that will actually change sentiment or investors' gut feeling towards the markets. If you get a recession there, they're less likely to invest even in these trends. They'll be disrupted. They'll want to go for safer assets in that environment. But generally speaking, you've got the underlying trend which is being driven by liquidity, and maybe a cycle of investment sentiment, which is more akin to maybe the swings in a traditional business cycle. So I'd look at it that way. In terms of the sensitivity of assets, again, you're correct. We did an analysis, and this was, I drew out immediately what you might say is a health warning or a wealth warning here, because this is based on historic analysis. But if you look at data, what the data shows is that every 10% increase in liquidity, you tend to get a 15% increase in the gold bullion price. Now that's over the medium term, and that's what seems to have transpired. If you look at Bitcoin, the answer, and this is what I say is a caveat, it's really in the period of the last 10 years. Bitcoin has actually had a multiplier of about 5 times. So in other words, it goes up 50% for every 10% increase in liquidity. Now that will not be what's going to happen going forward, but it still may be a high number. And that's the thing I think you've got to remember.
Why will that not
Clearly
be why will that not be moving forward?
Well, because I think what you've got is you've got an adoption effect. So, in other words, in the very early stages, Bitcoin was a comparatively illiquid asset. Now it's a more liquid asset, and I'm talking about liquid being here market depth. And the fact is that you've had a lot of investors who are already there. You may have others who will come in. But I think that the sensitivity, once the market becomes more institutionalized, the sensitivity of the market to short moves in global liquidity, in short-term moves, will be less, or I would imagine it would be less. I mean, never say never, of course. It may be that that's actually a robust figure, the 50%, but I would counsel that it probably isn't.
And that's because as the market cap of Bitcoin gets bigger, then the asset itself becomes more liquid as far as the daily trading volume. I mean, I can get more in and more out. And so as it becomes a more heavily traded asset, then it's a lot harder to move. That's why the sensitivity goes down.
Yeah, exactly right. Exactly right. So that's correct. But then you see, if you go back, I mean, you keep drawing or draw out the example of Stan Druckenmiller. I mean, Stan Druckenmiller learned a lot of what he was doing in global investing by looking at Japan in the 1980s, and that's when I remember him. And he was then, very clued in to what was happening to liquidity in the Japanese market, and liquidity was a key factor driving the Nikkei higher and higher and higher. It wasn't about valuation. A lot of the traditional value investors piled out of Japan in 1984, but the market kept rising for another 6 years or 7 years.
Well, couldn't you say the same about Turkey's stock market or Zimbabwe's stock market as well? All those asset prices in the stock market are making new all-time highs in nominal
Yeah, I think
terms.
exactly. And I draw the analogy, and I'm not suggesting this is maybe a fair analogy, but it's a point to ponder. And this is an example I give with people that say that don't invest in Bitcoin or altcoins or whatever because they're basically they're empty assets or whatever, or they're fictitious assets. My example is to go back to Germany in 1923 with the hyperinflation. Now, in 1923, just before Germany saw this massive inflation, as the government again was printing loads of money, and I stress the fact that we're not going to get hyperinflation in the US, but the direction is important, I think. In that case, many older generations invested their wealth in government bonds because that was the world they knew. They depended on the government. They thought the government was reliable. They kept their money in bonds. That's what they'd always done. That's what their parents and grandparents had done, and they got wiped out. The younger generations instead did not invest in bonds. They invested in the stock market, and they basically kept their wealth. And what you saw in Germany in the 1920s, with obviously unfortunate consequences, is there was a massive wealth distribution shift from the older generations to the younger generations. And I've got no evidence for this, but I would imagine, or I would strongly believe that through that period, the older generations were schooling their children to say, you're absolutely mad to invest in stocks here. Why don't you fall back on the reliability of government bonds because they've always worked? What are these pieces of paper you're trading for company securities? I mean, they're completely worthless. But actually, we know that they weren't. And isn't that exactly the same argument that the older generations are saying to the younger generations now about Bitcoin and altcoins? The younger generations basically gravitate to these instruments because they're probably very good monetary inflation hedges, and they understand them.
Yeah, I mean, there's certainly that. We can dig into that. There's also that in times of high inflation, hyperinflation, however you want to define that, what happens is it turns into a culture of gambling, right? John Maynard Keynes said that Vladimir Lenin told him that the best way to destroy capitalism was to debauch the currency. Through inflation, they could arbitrarily steal wealth until all relation is lost. And the best way to get rich was gambling and theft. And so that's sort of what we see when societies start breaking down. And so was it just 2 weeks ago? GameStop was back in the news. Everybody's YOLO into GameStop. And so not that there's really any valuation there. I think in Germany maybe they were buying notes of equities of maybe productive companies. So it's a little bit different, I think, than buying GameStop or some altcoins, meme stocks or whatever. But certainly to the point that you're making, I mean, Bitcoin, obviously I'm a big believer in Bitcoin, is a new alternative asset. Do you think, so Bitcoin is the first time we've seen an asset that has true scarcity, so a fixed supply of 21 million. And do you think that has something to do with it? I mean, if you look at whether it's real estate or art, it's always the scarce assets that move many multiples higher than the existing assets, right? And so in this type of environment where we're seeing unlimited money printing against the face of an asset that has a fixed supply, I mean, how does that interact?
Well, I think you're absolutely right. I mean, this is it. What is it? I mean, you'd know better than me, but what is the limit? 21 million Bitcoin, I think, is it?
Yeah, 21 million Bitcoin is the max supply. It's the first time that we've seen an asset that has true scarcity, a digital asset with true scarcity. Obviously, like a Mona Lisa, there's one Mona Lisa, so it's true scarcity as well. Yeah. But the first time we've seen a digital asset with true scarcity, and so it's hard to imagine where that goes, but I think we're seeing that.
Yeah, I think that's right. I mean, the only question one's got to raise, I mean, there have been other examples of scarce assets, prime real estate, Mona Lisas or whatever, but their price goes up. I mean, that's what we know. They hold their value. Bitcoin is an example that certainly should do. I think the question that, I've posed many times in the last few years is, I mean, is there a chance that you get something equivalent to the Gold Act in the US in 1934, where the Gold Act basically made it illegal for private individuals to hold gold? And the penalty of I think it was a 7-year jail sentence and a really hefty US dollar nominal fine at the time. So that focused the attention. Now, could the administration do something similar? I would doubt that now. I think that the horse has bolted. So I think it's very, very difficult. Bitcoin is a global asset. It's not under the control of the U.S. administration or how much they may like that. And I believe I'm correct in saying that Trump, over the weekend actually endorsed the whole idea that there would never be any constraints on crypto.
Yeah, so just to catch you up on that, I mean, that has been the number one people who don't believe in Bitcoin, that's sort of their number one attack vector is like, but the governments will make it illegal. And obviously there's good reason for that with Act 6102, where they made gold illegal, to your point. But yes, not only did Trump endorse it, but we had other leading candidates. Vivek Ramaswamy, he was out endorsing it. RFK Jr. has been out endorsing it and receiving campaign contributions in that. But more importantly, last week, the House passed a bill that basically, so we have a couple things going on. We have multiple states that are breaking apart from federal government. And so now Montana, Oklahoma was the latest one that basically passed a law. The state passed a law to protect people's right to own Bitcoin, custody Bitcoin. And so the states are now moving in advance of the federal government. But then the federal government, the House, passed a bill that also guarantees citizens' rights to own Bitcoin, self-custody Bitcoin. And so to your point, I mean, could that be overturned and, whatever? Sure. I mean, everything's a possibility. But as it looks right now, they have gone above and beyond and actually put sort of what the Constitution does is guaranteed those rights. And so that's a pretty big deal. And to the point that you made, yes, I mean, even if the U.S. said, hey, we'll kill you on sight if you have it, it doesn't stop the rest of the world from moving in advance of that. So I think to your point, the horse is bolted. The horse is out of the barn. It's too late to close those doors. So kind of if we look at this lens then, and we have this tech trend as you called it. So there's certainly AI that's sort of driving markets, like Nvidia, is catching that. I think copper is even this old metal that's starting to sort of move on this tech trend, if you will. Maybe that's the energy transition. As well as the AI, right? Massive data centers, things like that. I've mapped out about every 50 years, we have these chondroitin waves, these K waves, and every 50 years, there's like this technological revolution that happens. And each one of those seems to drive financial markets. So we had the Industrial Revolution, we had steam engines, railways, we had steel, electricity, heavy equipment, we had oil, automobiles, mass production. 1971, we had microprocessors, which brought telecommunications, personal computers, internet. And now we have this like next tech boom. And each one of those drove financial markets. So back to that trend. So we have this tech trend, which is why I referenced the NASDAQ, not the S&P 500. So you sort of have this NASDAQ, and obviously Bitcoin, crypto overall is sort of driving that. And then if we look at, we have these global liquidity cycles that seem to be happening globally every 4 years. And these tech, so we have the tech trend, we have the NASDAQ represented sort of moving off of debasement. And based off of sort of the way you framed it up, and I want to get deeper into this, the pool of collateral, the base of the system is so important, we can't let it collapse. So we're going to have to keep kicking the can down the road. So we're going to have to keep debasing, and it's going to keep pushing prices up higher. And then that's in the backdrop of this tech, crypto, AI boom. Do you think it makes sense to sort of be a Warren Buffett and be more concentrated in your bets, put your eggs in one basket and watch the hell out of that basket, as I think he said? Like, instead of this diversified thing, it's like, no, like we can pretty clearly see that these are trends that are going to happen. They have to continue happening. At least the base case is that they'll continue to happen. And we can see what's happening with the tech stocks and Bitcoin. And so maybe it's time to sort of focus more on that, or no?
Well, I think it comes down to I think it's a very interesting debate. I think it comes down basically to what first of all, your time horizon. So if you're a young guy who can is going to be saving or working for the next 40 years, then you can take a long-term view, and maybe short-term volatility doesn't matter too much in that regard. You're right also to say that the most successful investors did not diversify or do not diversify; they concentrate. However, what they face is en route is significant volatility. Keynes, who you cited earlier, was actually also somebody who didn't believe in diversification. He believed in his phrase was, "I put all my eggs in one basket, and I watch the basket very closely." And that's something I think one's got to think about. If you believe that these are the safe assets of the future, then I would definitely go along with that. I happen to believe strongly that these are important. I'm not going to say I've got all of my investments in Bitcoin or in associated vehicles, but I think I've got substantial amounts because I think that the real threat out there is monetary inflation. And where we are today, which is very different to where we've been at any time in my investment career over the last 30, 40 years, is that governments are really in a situation where they can't really do very much. All they can do, as we keep saying, is to kick the can down the road. Now, you think of the alternatives to that. The alternatives would require a revolution in demographics, which we're clearly not going to get. It would require the ability of the government to hike interest rates significantly to discipline the markets. But they can't really do that because if they do that, the debt interest bill just skyrockets. And then you get an even worse situation with debt growing exponentially. And they probably don't want to cut interest rates too much either on the other side because they incentivize people to take up too much debt. So they're really stuck. And there's an old saying in Ireland that if you want to travel to Dublin, don't start from here. And that's where we are, unfortunately. So I think the fact is that what you're going to see over the next few years is governments increasingly kicking the can down the road. And it's those that have got maybe the bigger boots on, like the US, which is going to succeed rather more than some of these smaller countries who haven't got the same resources or haven't got an international currency like the dollar.
Yeah, so you said that the U.S. is a pristine borrower until it's not. So I think to the point that you're making, I mean, that's obviously, I agree, and I'm also trying to make that same point. And if we look at ancient history as well as current history, that's what it tells us. So going back to Turkey and Zimbabwe I referenced earlier, or Venezuela, Argentina, name your country, what we see is they're all going to print until the printer doesn't work anymore. None of them just say, well, fold up shop, just shut it down. Like they all just go until it doesn't work. And so it's like the law of diminishing returns. And so that sort of seems to be the way it's going to continue to go. They're just going to keep kicking the can until the can doesn't kick anymore. But you said the U.S. is a pristine borrower until it's not. What we're seeing is obviously with the rise of the BRICS, sort of the decentralization or maybe deglobalization of the world, if you call it that. China and Russia have both been openly claiming to be de-dollarizing since 2014, about a decade now. And what we're seeing is even now, like in Saudi Arabia with the oil, is like the surpluses are not being recycled back into dollars or treasuries. Now they're being recycled into gold. And maybe that's part of the reason why gold is also catching such a bid right now. And I'm just curious what you think about that dynamic, and if that's the U.S. is a pristine borrower until it's not. Does that sort of shorten the runway that they might have as countries start sort of recycling into other assets?
Yeah, I think this is a key area, and I'm not sure I've got the answers, but I think I can pose some questions here. I think the interesting point and the interesting maybe opposite correlation that one sees is that whenever the Chinese current account surplus or trade surplus rises, the dollar goes up, and we shouldn't be seeing that. It should be the other way around. So what's happening is there's yet another price in the international financial system that's not working properly, or it's working perversely. Now, why is that the case? And I think there's a number of reasons why you may be seeing that. One could be that, in actual fact, China is a dollarized economy. So it's a little bit like saying, although I don't want to push this analogy too far, it's a little bit like the state of California. Okay, so what you've got is a dollarized economy. If California was hugely successful, what would that mean for the value of the dollar? Well, difficult to say is the short answer. And I think that's the case with China. If China is pricing everything in dollars, then it's not necessarily telling us anything about the demand for yuan, Chinese yuan, because it's basically sitting on dollars. Now, you could argue against me and say, well, of course, China is now pricing a lot of its goods, or oil in particular, from Saudi Arabia in Chinese yuan, and therefore it's getting paid in Chinese yuan. Saudi Arabia is getting paid in Chinese yuan. But the key thing is that Saudi Arabia is not keeping money in Chinese yuan. It's shifting it into gold, or it's probably playing it back into dollars. And the critical day is when the Saudis decide they want to save in yuan. That day has not come yet, and I think it's going to be an awfully long way off. And I would venture that simply because if you look at what's happening in the Chinese markets, and this is the big problem that China has got, is of course they've got capital controls. And what you're looking at is a situation where the yuan looks to me to be a fundamentally weak currency. Even despite the fact that there's a whopping great trade surplus, capital wants to leave. Now, I would venture that if capital controls disappeared in China, you would see a wave of money leaving the Chinese yuan and going into international diversification, international assets. It may well go into things like gold in much bigger size if it could. It may well go into things like Bitcoin if it could. So these are interesting things to speculate upon. Chinese savers have got a lot of money. And the bottom line to this is, I don't think they can get off the dollar hook very easily at all. And one of the reasons I think the dollar goes up when the Chinese surplus expands is simply because increasingly the Chinese are not depositing their money in US banks. They're depositing it in fringe banks, in other words, in the Middle East or in Asia. And the recycling abilities of these banks to actually push it back into the system is actually more challenged than a conventional US bank. So you've actually lost the elasticity of supply in terms of the recycling of dollars, which explains why the dollar's a lot firmer than people think. Now, I think that could go on, but that doesn't detract from the fact that I think that gold outperforms the dollar, and I think that Bitcoin outperforms the dollar, but I still would maintain that the paper dollar is still significantly better than maybe the euro or the British pound or the Japanese yen.
Yeah, so that's the, back to all these examples, but like the dollar milkshake theory, where it sort of becomes the strongest lasting currency. As a lot of people say, it's the cleanest shirt in the dirty laundry, so to speak. But it's totally possible, and what I see is that the dollar gains strength against other currencies, but it loses against hard assets. So it's losing against commodities. Yeah. So in that example that you gave there, so basically China is still working in dollars, but because some of these banks that they're putting their dollars into, it's not as easy to get them back into the global system, so thereby it's lowering the amount of circulating dollars. The big problem is that most of the debt around the world is denominated in dollars. So if the amount of circulating dollars go down, it makes it harder to repay that debt, which makes the value of those go up. I guess, and this is going way outside, but maybe there's something to think about in light of where we're at with Russia, Ukraine, and so forth. And now China and Russia have now sort of stepped up their military cooperation. But I think maybe the Biden administration is what we'd say in the U.S. has jumped the shark, so to speak, by seizing Russia's assets and now saying they have to pay for war damages. And now Russia is like tit for tat. Well, we'll just take back U.S. assets. And so it wouldn't be that far of a stretch of imagination to think that some of these nations might just say, well, we're just not going to pay that debt back.
Yeah, I think people do strange things when they have their wealth threatened. We saw that in 1941 with Japan, when the US froze Japanese bank accounts in the US to stop Japan buying oil in dollars, and that was something that actually led to, obviously the beginnings of World War II or American participation in World War II. So a lot of these things can actually have very, very, very big consequences.
Okay, so we'll kind of wrap this thing up. It's been a great conversation. I appreciate you taking the time. But let's just kind of if we recap this. The world got put into these, well, one, we've seen central banks of the world sort of change the way they intervene in markets and being much more willing to intervene. The timetables of how they intervene in markets has been stepped up. And now, they don't even intervene. They already have, I like to call them credit cards, but swap lines set up and things like that. We see these 4-year cycles or these liquidity cycles sort of moving in sync potentially. We have this massive base of collateral that's super important, so they can't let that dip. So that's one reason why that wheel has to continue turning. That debasement is moving asset prices higher, and we have the tech trend on top of that. Some assets are more sensitive than others, tech assets, Bitcoin, Ethereum, as you've pointed out in your research. And there doesn't seem to be any way to stop this train from just continuing down this path until something happens and we don't know what that is. Does that kind of frame this up?
I think that's correct, but I think that one of the things I think to think about here is to say that if you go back to listen to what a lot of economists would argue, they say that these levels of debt to GDP or public debt to GDP that we're looking at prospectively, whatever it may be, 150%, 250% of GDP are unsustainable. That's wrong. History shows it's sustainable. That's the worry.
How does history show that? Everyone cites the report from Hirschman Capital that every nation that's ever gone over 125% failed. The only one that's ever survived was Japan.
Well, Japan has, Britain did. Britain survived through the 1940s and 50s with, I think, public debt to GDP hitting 250%. So way above where US levels are now. Now, did that mean that the British economy was a rip-roaring success? No, rather the contrary. What you saw was basically decades of stagflation, and I would argue that the British economy has never recovered from that episode. So one of the costs of taking on large amounts of unproductive public debt and paying for it with funny money is you actually destroy your economic system. You get very slow growth, and that may be a cost of that. But it doesn't mean to say that it's unsustainable. It's fully sustainable because basically the government is the debtor, and the government can always print money itself, and that's pretty much what it's doing. So the problem comes is if you've got if you're borrowing in foreign currency and you don't have the ability to do that. So I think what you're looking at, and this is one of the things that I think you've articulated very well in terms of your observations, is that what you're looking at is a lot of debt machines around the world now, where these governments, be it the Eurozone or be it the US, which are just creating debt and they're basically funding it themselves. And that's the world we're in, and therefore that is what I call monetary inflation. And you want a protection against monetary inflation. The obvious one is gold. Equities are not bad. Prime real estate is not bad. But what has come through to shine, excuse the pun, is basically Bitcoin in the last 5 years. And that shows that it's performing like exponential gold. And why shouldn't it continue? Because as we rightly point out here, it's the only asset we can think of that's got a limited supply.
Why do you? This is going out on a stretching this question here. Why do you think an analyst like Peter Schiff, who seemingly knows so much about Austrian economics and understands this so well, just cannot see any value in Bitcoin?
Well, I don't know really. I find that hard to believe. I mean, the question is what is intrinsic value anyway, and that it's always a philosophical point. But something is worth something, has a value if somebody else thinks it does. And if people believe that Bitcoin is a store of value, then it is a store of value by definition because people will accept it. So that's one of the criterion of money. So I think that's true. I mean, we can debate long and hard about whether, is a paper dollar got any value in it, because there's no intrinsic value in that. There's a promise to pay. And I suppose with Bitcoin, there is an implicit promise to pay there or to redeem the token. So I find it's very difficult to argue what other people, why other people are saying what they're saying.
Yeah, I agree. I mean, all value is subjective, and but then you have to recognize that then to the point of intrinsic value, then that means there's some utility in that value, and I think maybe that's the argument he makes. But it's like, how else can you send money peer to peer digitally? Censorship resistant, right? And so there's a lot of utility there that's not there. But well, Michael, we've kind of run the course on the time here. I really appreciate you taking the time. I subscribe to your Substack. It's great information. I'm going to link to that down below for everybody that's listening. The Capital Wars book, if you really understand global liquidity, which I think you should. It's what I've been paying attention to. Check out that book. We'll link to that down below. Anything else you want to point out while we're here, Michael?
I don't think so. I think what you've got to watch is the three things that I've probably mentioned. You've got to watch what the Fed is doing. You can look at that every Thursday, 4:30 p.m. Eastern Time, with the H4.1 release. That's worth looking at. Look at the People's Bank of China, what it does in the markets, and also check out what's happening to the value of collateral, of which the best heads up, in my view, is to look at something like the MOVE Index, the index of volatility in bond markets, which is a pretty good guide to the size of haircuts that credit providers will give on collateral. So it will give you some sense as to how, what the collateral multiplier could be. And those three together are very good, insightful factors for understanding global liquidity.
Yeah. All right, we're going to wrap it up with that. Thank you so much.
Thanks so much, Mark. Pleasure. Thank you.